There were 10 people in the room when the money appeared. No announcement, no countdown, no dramatic moment. Just a quiet line on a balance sheet changing. And suddenly, billions existed that didn't exist the day before. By the time the rest of the world noticed anything had changed, those 10 people were already positioning themselves, buying, allocating, moving, not reacting to the system, but moving ahead of it. And that's the part most people never see. Because from the outside, it looks like wealth is created in public, in markets, in headlines, in big, visible wins. But the real shift, the one that decides who gets rich, happens earlier, under the hood. Right now, this matters more than ever, because the system we live in doesn't just allow this dynamic, it depends on it. Every time there's a slowdown, a crisis, or even a hint of instability, the same response kicks in. More liquidity, more support, more money entering the system. And every time that happens, the same quiet sequence begins again. The same early movers, the same advantage, the same outcome. To understand this, you have to stop thinking about money as something static. It's not a pile, it's a flow. And where that flow begins matters more than where it ends. Imagine the economy as a network of pipes. When new money is introduced, it doesn't rain down evenly across the entire system. It enters through specific entry points. Primary dealers, large banks, institutional channels. Places that are structurally closest to the source. These are not random. They are built into the system, designed for speed, stability, control. But they also create something else. Priority. Let's make this concrete. A central authority decides to inject liquidity, say hundreds of billions. This isn't handed out to individuals. It moves through financial institutions first. They receive the funds, often in exchange for assets or through lending facilities. Now they have access to capital at a moment when the rest of the market hasn't fully adjusted. That moment is everything, because prices don't instantly reflect new money. They lag, and that lag creates opportunity. If you receive capital early, you can deploy it into assets that are still priced based on yesterday's reality. Stocks that haven't surged yet, bonds that haven't repriced, real estate that hasn't absorbed the new demand, so you buy. Not aggressively, not loudly, just early. Then the ripple starts. As that money moves outward, through lending, investment, spending, prices begin to respond. Gradually at first, then faster. Markets rise, assets inflate, confidence returns, and from the outside it looks like a recovery, or a boom, or a new opportunity. But by that point, the advantage has already been claimed. This is the part that feels almost unfair. Because most people only interact with the system after the ripple has spread. They don't see the entry point. They see the reaction. They open an app and see markets going up. They hear that conditions are improving. They're told this is the time to participate. So they do. They buy into strength. They enter after confirmation. They follow momentum. Which, in this system, often means paying higher prices for assets that were cheaper just weeks or months earlier. Assets that were accumulated quietly by those who were closer to the source. Now zoom out and look at the pattern. This isn't a one-time event. It's a cycle. A financial system on the edge. Liquidity floods in. At first, fear dominates. Markets are unstable. Most people pull back. But under the surface, capital is being deployed. Large institutions, funds, and well-positioned players begin acquiring assets at depressed prices, not because they know the exact bottom, but because they have access, liquidity, and time. Then the recovery begins, slowly, then steadily, then undeniably. Over the next decade, asset prices climb. Equities reach new highs. Real estate rebounds and then surges. Wealth expands, but not evenly. And once again, the largest gains go to those who entered early. Fast forward, another shock, another intervention, another wave of liquidity. This time, faster, larger, more direct. And once again, the sequence repeats. Early access, quiet positioning, rising prices, late participation. At this point, it starts to look less like coincidence and more like structure. Because it is. The system isn't designed to distribute new money evenly. It's designed to stabilize, to transmit, to function through existing financial channels. But those channels are not neutral. They are closer to some participants than others. And proximity in this system is power. Now here's where the math becomes uncomfortable. Because over time, small timing advantages compound into massive differences. If you consistently buy assets before they rise, if you consistently access capital before it becomes expensive, if you consistently move ahead of the broader market, you don't just earn more, you accelerate away from everyone else. Meanwhile, those who enter later face a different equation. Higher prices, lower yields, more competition, less margin for error. They're not locked out, but they're playing a different game. This is why two people can follow similar financial advice, invest regularly, stay disciplined, and still end up in very different places. Because one is interacting with the system early, and the other is interacting with it after it has already shifted. Now here's the subtle twist. Even the 10 people under the hood aren't controlling everything. They don't decide when crises happen. They don't script outcomes perfectly. But they are positioned to respond first, and that's enough. Because in a system driven by flows, not just fundamentals, timing shapes reality. And the earlier you are in that flow, the more options you have. You can take risk when others are cautious. You can buy when others are selling. You can wait when others feel urgency. Not because you're smarter, but because you're earlier. Now, contrast this with the story most people are told. Markets are efficient. Opportunities are equal. Success comes from discipline and long-term thinking. Again, none of that is entirely wrong. But it leaves something out. It ignores how the starting point of money changes the outcome. It assumes everyone is entering the system at roughly the same time, which they're not. And once you see that, a lot of things start to look different. Sudden market rallies feel less mysterious. Asset bubbles feel less random. Wealth concentration feels less accidental. Because underneath it all is a simple mechanism. Money enters somewhere first, and whoever stands closest to that entry point moves first. Everything else follows. Now take this one step further. Because the system doesn't just repeat, it evolves. Interventions are becoming faster, larger, more frequent. The time between crisis and response is shrinking. The scale of liquidity is increasing, which means the window between early and late is compressing. And that makes positioning even more important, because by the time something feels obvious, it's often already priced in. This creates a strange tension. On one hand, markets appear more accessible than ever. Apps, information, global access. On the other hand, the underlying mechanics are becoming more concentrated. more capital flows through fewer channels. More decisions are made closer to the source. And the gap between those under the hood and those watching from the outside quietly widens. Not dramatically, not overnight, but steadily, until one day it feels like the system is tilted. Not broken, not rigged in an obvious way, just structured. Structured in a way that consistently rewards early access. And here's the part that lingers. If the system requires continuous support, if liquidity must keep expanding to maintain stability, if each cycle depends on new money entering through the same channels, then the advantage of being under the hood doesn't just persist, it compounds. Which raises a question that doesn't have a clean answer. In a system where money flows don't start equally, where timing shapes outcomes, where early access quietly defines who benefits most, what does fair even mean? And more importantly, where are you standing when the next wave of money enters?